Good afternoon, everyone. Thanks so much for joining this afternoon. We're going to do a case study, what I've lovingly referred to as employee ownership beyond the ESOP. And what we have here today is a case study and the three principles in the case study that made it happen with a company that was 100% ESOP owned and moved out of that structure, but yet still retain employee ownership. And so what we're going to do is just walk you through the basis for that transaction, how the transaction came about, how the transaction was structured, and a year post, how everything's looking. So where I want to start out is introductions. We have the three principals, as I mentioned, in the transaction. Darren Anderson, who is with Salas O'Brien Holdings. He's the CEO of the company, said company. Then we have Greg Fresh, who was the investment advisor for the company with respect to the transaction. And then lastly, we have the person who brought the money, Michael Kane with Caltius Structured Capital. So with that, Darren, I'll kick it over to you.
Thanks, Aaron. Yeah, happy to participate in this. Thank you for leading and making this happen. I'll give you a little background about Salas O'Brien and try to make it brief, but give you a little perspective. So today we're a 1,350 person professional engineering and technical services organization servicing kind of the built environment. We do complex facilities around North America. We're a highly engaged organization that's focused on employee ownership, very distributed employee ownership model, and that's been kind of our program since we started. We have migrated. When I first started 16 years ago, we were a $5 million a year, 30-person organization in one office, and today we have 51 offices, 1,350 team members doing $310 million in revenue, and a very profitable organization. And part of that has been it's hard to find great talent. And so employee ownership and retention has always been a key pillar of our success. And we've achieved every year no less than 90% retention of all of our team members. And part of that growth has come through mergers and acquisitions as well. We call them mergers from a philosophy of partnership. As we were looking to grow earlier in our career, I couldn't find great leaders and talent because they are very loyal and dedicated people generally to their organizations. And so after trying to recruit some talent, I finally said, you know what, let's go find organizations that are like-minded. And so we've used this as a way to bring great leaders into our organization, but also great talent and team members to help strengthen our team in total. And so we've done almost 20 mergers over the last 15 years. And we measure all of them very carefully based on three metrics of success. One is retention of our leaders in the organization. And of those mergers, we've had 149 employee shareholders that have joined us, and 144 are still in our organization today. And those other four, two retired at 77 years old, one guy at 83 years old, and unfortunately, one's passed away. Then I look at our overall retention, it's been always in excess of 90% every year. And last 2 years, we've been at 93%. So it's really important to ensure we're retaining our talent in the organization and making sure they're very vested in the organization's success. And so that's why we've also we've added the employee ownership component. So as we migrated from, there were three of us as shareholders 16 years ago, to when we first did the ESOP, we had 45 employee shareholders, and then more became employee owners because they just were excited about our growth and our prospects and wanted to be participating in the ownership of the organization. We finally, as we did the ESOP for 4 or 5 years, it was really was a natural evolution for us. And not to go too far down, because we'll talk about the reasons for the transaction structure that we did, but we undid the ESOP 5 years later, not because we didn't believe in employee ownership, but it was just the opposite, that we continued the employee ownership framework, but we just moved the structure away from an ESOP back to a direct ownership model. And there were good reasons that we'll discuss, I'm sure, later on. But we continue, growth is important for us, but never at the compromise of quality and reputation in all that we do. We've got a highly engaged employee ownership team and leaders, and yeah, the future is very bright for Salas O'Brien, and I'm very grateful for you, but also for Greg and Michael as our partners to help navigate through a very complex transaction to make sure that we're well positioned for longevity and future success as an organization.
Fantastic, thank you. Michael, would you do a little bit on Caltius so that we understand what you guys do?
Great. And again, thank you, Aaron, for having me, as well as having Greg and Darren. This will be an interesting discussion. I look forward to it. So Calteus was started almost 25 years ago. Three of us founded the company. We are still the employee owners. So we at Calteus are employee owned, as well as like investing companies like Salas O'Brien that are employee owned. We started as a pure mezzanine debt fund focused on the lower middle market. Our first fund in '97 was $43 million. This transaction was done out of our fifth fund. So if you do funds 1 through 5, we're up to about $1.5 billion. And we hope to close on our sixth fund, which will be another $400 million at the end of this year. So we're very excited about that. If you go back to our founding, interestingly, because the first fund was so small, we kind of learned how to do mezzanine debt, and now we're called structured capital because we do a lot of preferred equity as well, like we did with Salas O'Brien in this particular transaction. Because that first fund was so small, every transaction in that fund did not have a private equity group. They were smaller companies, and so we had to do our own work. So while we had no control at the end of the day over any of those companies, we were the sole institutional partner, maybe alongside a bank. As we've grown the fund and grown the business, and now we're at a size where we're competing with deals that involve private equity firms, we still have maintained about 80% of our transactions are with management teams buying a company, or families who own a company, or employee ownership situations. That's what we do. We have found that while they're harder to source sometimes and harder to structure, and again, we'll get into some of the structural nuances of this deal, this was right down the middle of what we want to do. Again, we did a substantial amount of junior debt, junior to Salas O'Brien's bank at the time. And then we did an equity investment so we could partner with Darren and the other employee owners in the growth of the business. And again, we'll talk about how it's transpired, but we were very excited when we did this a year ago, and we're probably more excited about it now. So, and
Thanks, Michael. Greg, how about a little on Chartwell?
Well, thank you. Thank you again for allowing Chartwell to be a part of this. And thank you to Darren and Michael for being partners of Chartwell. And particularly delighted to be a part of the transaction that we're going to be talking about this afternoon. Chartwell is a middle market, privately held financial advisory service firm. We focus myopically on privately held businesses, family founders, ESOPs, anything really where private ownership is a big part of the company's makeup. We've been around since '95. We have about 12 managing directors, 100 employees in total. We're in 8 cities. We're headquartered in Minneapolis, which I'm speaking to you from today. We do about 50 transactions a year and an install base of roughly 500 clients, which about half of those happen to be ESOP owned. I head up the corporate finance functions. In our business, we represent boards, management teams, shareholders, where the counterparty could be a private equity firm like Michael's firm, or it could be a strategic acquirer, or it could be an ESOP trustee. In some cases, it's all the above. So that's a little bit about Chartwell and myself.
So Darren, let's just jump right into it and get to the background of the transaction. What was the impetus for wanting to do anything? You were 100% ESOP owned company. Presumably things were going decently. You fully embrace employee ownership. So why the change?
Yeah, great question. That's the crux of it. We were doing very well. We had continuously built our organization with solid leaders, solid team members, and making sure we're sharing the rewards of employee ownership. We'd continue to expand the ownership, as I had mentioned. And the ESOP structure, we had, as I said, 45 employee shareholders, probably now 6 years ago, as we continue to grow. That represented about 20% of our overall company. More people were really wanting to be a part of the ownership, and we wanted them to participate. And so we moved to an ESOP, 100% S Corp ESOP. And it was very attractive for many reasons, as I think probably people on this call know. One, for those selling shareholders, it was the eligibility for 1042 benefits was very attractive. And I think also just having our team members being employee owners was very appealing, that we had nurtured that mindset, and it was great for retention in a very hot market. We have a hard time finding great people in this space. And so for those reasons, as well as that we would become a non-tax paying, basically for-profit organization, it was very, very appealing. And it worked really well. So we continue to be an ESOP, 100% S Corp ESOP for 4.5 years. The challenge became our cash flow and our strategy had been severalfold: continue to grow the practice, make the right investments. So ownership was continuing to be allocated each year. We started to accelerate our merger strategy because it was working really well. And we were investing in certain markets that we wanted to get better in. And so we continued to find great merger partners that really fit our story well and made our organization stronger and better, and them stronger and better. And so we wanted to continue this growth. It was positive for our shareholder value. It was positive to strengthen the organization and created opportunity for everybody. The challenge was, as we continued down this path, those merger partners really believed in what our vision was in the future, but they wanted to have ownership in the organization. And we simply couldn't issue them ownership because they would be, say there are 5 owners of this organization, they would get no ownership in Salas O'Brien going forward, and they'd only get dribbles of ownership going forward as part of the ESOP. And that just wasn't meaningful and impactful to them. They were coming into this organization saying, gosh, I want to be a part of it, and I want to engage and drive the future success, but I'd like to be participating more in the upside of the organization's growth, and they simply couldn't. So that was difficult for them. So that was one component. And I'd say the other component is, as we continue to fuel this growth and find the right partners to join us, is that there was an imbalance going to be in the future between our debt and equity side of the business. And the only way we could raise capital was through the issuance of debt. And I didn't want to introduce too much debt and have an imbalance in our capital structure. So I said, we're going to be seeing this wall here in the near term, so let's plan for this. And we wanted to migrate back towards a more balanced debt and equity approach, so that it wasn't introducing too much risk, financial risk to the organization, as well as making sure that we had an indefinite ability to continue our growth trajectory because it had worked so well. Every merger that we've done has been 100% referenceable and very positive and been additive to our organization's success and to our shareholder value. So those were the main drivers that we finally said that because of our we wanted to continue our growth strategy and implement strengthening our organization, is that the ESOP was actually limiting our structure and our ability to grow and build success for the organization and for our team members. So that's where we talked to we'll say several different advisors. And at the end of the day, selected Greg's team because they had the most competency and understanding of ESOP structures, the complex transaction abilities, and to help us navigate through evaluation of alternatives. And so it was, Greg and his team were introduced to us by Leslie at UBS, and her confidence and trust in Greg really proved to be prescient. And Greg and the team did a nice job and really invested a lot of time in the relationship, and I appreciated who they are as people and as characters, and really did all the right things for us all along the way. And there were many tests of their objectivity and independence where they could have made decisions that were not necessarily in our best interests, and where they could have been well rewarded financially, and they chose to make the right decisions in our best interests. And that earned a lot of high compliment and praise and trust from my perspective. So anyway, that's a little background.
That's perfect. And an easy segue to Greg. So Greg, just a few minutes, if you would, on how you got re-engaged and some of the alternatives that you looked at before you got to the actual transaction structure that you executed on.
Yeah, thank you. And Darren, thank you for the glowing remarks. I'm not sure it's coming through on the video, but I'm blushing. But thank you. But obviously there were a number of, we start every relationship with trying to understand what our clients' objectives are. And I think Darren articulated those very well. One was, the capital structure of the company was becoming significantly levered. Lots of debt capital from the standpoint of the banks, third-party leverage, but also the seller debt associated with the original transaction. And then also seller notes that were from the merger partners or the acquisition targets. So when you looked at the total all-in leverage, it was pretty significant. The other objective was, and this is the theme, should be the first and last point, was to retain employee ownership. It made it very clear, Darren said, that at the end of the day, our employees have to be engaged and incented and be rewarded through equity investments, whether indirect or direct. So employee ownership, very, very key and central objective of Darren and the boards. The other was really to obtain growth capital. Darren has built a wonderful platform, as evidenced by his growth that he stated, and the growth is obviously exceeded everyone's expectations. Perhaps not only maybe Michael's expectations and others, but certainly he's overachieved in many ways. And then I think one of the other key components is Darren articulated was the fact that to have a currency for acquisitions. So for the acquisitions to have the opportunity to receive direct ownership. And all of those, were major considerations, which we then presented to the board of directors. And just as a way of reminder for the audience, the corporate finance governance and function is that of the board of directors. So in going through all of that, we presented a myriad of alternatives that seek to try to achieve these objectives, but none of them really achieved all of them until the one we concluded on, and that's obviously what we're going to be talking about today.
And Greg, maybe just to interrupt, but I think Greg touched on a point that I underemphasized. But as we've done mergers, a lot of the sellers had taken some notes back. And I wanted to make sure we had a couple pressures that would have come into the future. Not only we have bank debt, but we also had these merger notes that people wanted to get collected on. They were subordinate to the bank, but I wanted to make sure that we were performing on those and the people were getting their capital back that they had expected from us. So we had some competing pressures. We wanted capital to be able to grow. We had capital for repurchase obligations, and we also had capital to pay back some of the notes. So there were these three competing interests that we wanted to satisfy all of them at the end of the day.
And so, Michael, I believe you were brought in to help satisfy all those competing needs. Now, I know there's a little bit of conflict of opinion in terms of who brought whom in. I think you already knew, Darren. Greg claims he brought you in. So,
well, it was actually a good. I don't think there's a lot of conflict because it's a good combination of both. We had met Darren, our team. He's 50. His office is 50 miles away from where we are, so that helps. But as part of our marketing efforts, again, by wanting to find these employing companies, we try to find them ahead of time and meet management teams. So 3 years ago, so 2 years before the transaction, we first met Darren, and it was nothing more than an introductory meeting to his office. At that point, I think just contemplating some growth capital, wanted to introduce the concept of mezzanine debt and minority equity in terms of, hey, we're not a control investor. At the time, Darren's bank, who he had a good relationship, though, I think was up against some of their lending capacity restrictions. And so we talked to him early on about it and stayed in touch. There was no transaction at the time, but as part of our kind of how we go to market, always stayed in touch and wanted to make sure that we were thinking about him. So then about a year before Greg and Chartwell were retained, there was then more of a concerted effort on Darren's part to do some growth capital. And at the time, thinking about bank debt and somebody like us, and we tried to put something together. But at that time, while his current bank was capacity constrained, he found a new bank, Umpqua is the current bank, who put forth a very aggressive proposal of bank debt that that met the needs, the short-term needs of Darren and the business at the time. Obviously cheaper than the capital we were looking to provide. But again, and so we fully understood, but what UMCA was doing at the time made some sense. But again, based on what Darren had talked about, what he wanted to do, we knew together that there was going to be another bite at the apple, so to speak. Interestingly enough, and just a total coincidence, so I can't take credit for this being part of my marketing strategy, but Darren knows two CEOs of other Calteus portfolio companies. One was an incredible success and did exactly what Darren wants to do in terms of just an acquisition machine. And we kept putting more and more money in and doing acquisitions, and that company's become much larger and very successful. The other companies actually hit some bumps. So, can be an interesting point of reference for Darren and other teams to say, how do we behave when a company doesn't just do exactly what they say? So Darren had the benefit of not only knowing myself and our team for couple years before, but having some very good reference points who could be totally and open honest with him. So we stayed in touch again, and then and we saw that. So once the Chartwell process, and we had known Chartwell, just part of our calling efforts. Hey, we're Calteus, here's what we do. So Greg and his team did then reintroduce us. We had the benefit not only of knowing the industry, but knowing the company. And maybe as important as anything, when we saw the original package of information that Chartwell was presenting to all potential deal sources, we kind of knew from knowing Darren what he'd said that he was going to do. And now we could see confirmation that he really had performed. So having the benefit as an outside investor of knowing Darren, didn't know his team well, but knowing Darren, he's saying, here's what we're going to do and execute on, then seeing a firm like Chartwell put together a memorandum that then outlined what he had done and saying, wow, that's exactly what Darren told us, made it a lot easier for us to get comfortable. And at the time, propose an option. As Greg mentioned, they were considering 2 or 3 different concepts. What we wanted to be is we can only really do one of those options. So if the board wanted to go in a different direction, we weren't the right solution. But if they wanted this debt and minority equity solution with a group that Darren knew that does 80% of transactions with employee-owned companies, we really fought hard to be that right solution. And then once Greg and the board decided, Greg advising the board and Darren that this was the right option, we were well prepared and ready to go, and I think did everything on a timely basis alongside advisors like you, Aaron, and Greg, and the other councils involved, because as we'll talk, it was a highly complex transaction.
It wasn't easy. So
No.
Greg, with that, let's give the audience a little bit of a description of what actually did happen and how we transitioned out of 100% ESOP owned company.
Yeah, and again, keeping the objectives in mind, which really steers the course for the solution. I think we've kind of went through those, but just a refresher was to delever the company, both bank and internal debt, retain employee ownership, obtain growth capital, have an acquisition currency. Another one that we advised the board was really 2 subsets of a control deal or a non-control deal. And where we ended up for a variety of different reasons, we ended up in a non-control situation. I think Darren has seen, he's been in the industry for quite some time, obviously has seen where deals work and didn't work, and didn't want to put his employees through a control situation that would change his culture, which is a very big part of the subset of retaining employee ownership. Culture is paramount with Salas O'Brien. So after we've concluded on the transaction that we all thought was the right path, we had a number of technical steps that we had to go through, and some of them had to actually happen in the right sequential order. Otherwise, it would be not necessarily a great outcome. But the first order of business was really making sure that our ESOP was up to date, i.e. all the administration documents and the like were up to snuff. So that's where Erin and her team came in on a review to make sure that those documents were squared away and we didn't have any open issues going into a transaction. And equally important was to confirm the administrative value, the fair market value. The fair market value per share was going to be the construct for a lot of different things throughout this exercise. Somewhat concurrent with that was informing the ESOP trustee of the board's intention to effect a recapitalization and articulated to the board its strategic importance. As you know, the ESOP trustee has a duty to monitor the board's activities. So we fulfilled that requirement by giving the trustee a well-informed set of objectives and alternatives. And Aaron's going to take you through the actual mechanics of the conversion, but when we get there, part of the deleveraging process was the next step, was understanding the true debt capacity and the optimal debt capacity of the company. So part of it was restructuring the bank debt. Another part of it was really determining within the seller notes and merger notes who was going to stay and those that were going to retire. And that kind of gave us a decision tree of those that may convert their share or their note balances into equity, and others that may want to take cash. So that was, and I got to hand off big congratulations and kudos to Darren, because he led that entire exercise with multiple parties and multiple series of one-off negotiations, if you will. Part of that obviously is when we went to this type of structure, we had to convert from an S corporation to a C corp, because we didn't want to deal with the pass-through issues and the single class of stock issues. So there's a lot of discussion around S to C, which we informed the board on to affect this transaction. So that was a big step. But then when we knew what our debt capital structure was through all this restructuring, we also then went to the next step and understand what the equity structure would look like. And that was taking the conversion of both our warrants and our SARs, our synthetic equity package, and converting that into common. So then we knew the pre-cap table before we introduced Michael. So Michael knew exactly what he was investing in and exactly what his post-closing ownership would be. So lots of different steps. It had to happen in sequential order to make sure that we did everything right and had an efficient transaction.
And so part of the, and help me out here, Greg, part of the cap structure, pulling off of your terms, is we have a preferred instrument that Calteus holds, correct?
Correct.
We have common that is held by the employee owners.
Correct.
And then the last piece was my piece, which was taking a slug of the ESOP ownership and basically merging it into the 401k profit sharing plan that the company holds, and having that operate as a privately held company stock fund within that 401k plan. And what that allowed us to do is have outside ownership, which Darren was needing for those acquisitions and for just demand and retention, but also still retain some tax benefits of that retirement plan ownership of company stock, so that employees can continue to get some allocation on a go-forward basis. And as we're doing it now, the matching contribution is going in company stock, driving that rank and file ownership, as well as the individual ownership outside of any plan for those key drivers. So a very well-structured cap structure in my mind. Darren, what are your thoughts?
No, 100% agree. There were so many iterations of this to ensure it was successful for everybody. It was so important that this story had to be that this was a positive benefit for everybody in the organization. And I'd say because of your knowledge in this space and Greg's experience, everybody has not only seen initially, but also experienced that this is so positive for them. As we're able to roll all of the ESOP shares and give an additional allocation to this profit sharing plan where they continue to roll into this deferred comp program, they're now seeing accelerated appreciation and no limit of what we can achieve in the future, whereas we would have been capped. There would not have been the same appreciation and growth in the value of the shares. And now we're kind of limitless again on what we can do and the success that can be achieved. But then how the benefit of that ESOP allocation each year to the team members, how is that going to be replaced? And so very creatively to be able to just increase our company match on the 401k and do that in company shares has been very valuable and so well received by everybody. And so it really replaced what the ESOP allocation was each year, continued to allow us that unlimited or unrestricted growth, but it achieved all the same benefits that the team, or similar benefits the team was getting. So it was a very, very elegant solution that took a lot of thought and a lot of iterative conversation to find the right place for it. So many kudos to you guys and the team of getting to that solution, because it would not have gone over as well without having really brainstormed on different possible paths to ensure everybody was whole.
Right, and if I might chime in, and Greg pointed this out, a lot of this was baked when we got involved, and obviously we had, as part of our diligence, had ESOP counsel come in, and it was very well structured by the time we were introduced to it, such that, you know, we could just opine and really focus on our underwriting and more the economic reasons for the deal and the growth concept. So it was very well put together.
So tell us, transaction closing, how did that go? And then we're basically a year post. How are things looking? Both Darren and Michael, I'd like your thoughts.
Well, look, Darren, maybe I'll go first this time, and then you the closing was fun. I think we were all right there. Obviously, there's always, when you get something this complex, there are little glitches, but those always happen. So I didn't feel there was anything material as we got closer to closing. You know, very slight delays, but it all came together pretty well. And again, a lot of that was because we spent a lot of time, both again before we got involved, and I think us with our counsel, so that when we got close to closing, it was ready and well baked. You know, I look at the first year, and it's been great. I think more of Darren and the team now, and we've gotten, as part of our diligence and being a board observer, we've gotten to know a lot of members of the team. You know, when I travel, as little as I've done, but, you know, trying to meet. Darren's been nice enough to introduce me to several members as I travel of his team around the country. But, you know, they've executed on a number of additional acquisitions. The integration of the acquisitions that were done just prior to our transaction and as part using some of our capital have gone well to date. Obviously, still early for most of them. I think the company did a great job in taking some PPP money, and not only, I think, maintaining their employee base, but increasing it during COVID. So I think accomplishing exactly what the SBA and the government wanted to accomplish with that program, and those loans have now been forgiven. And so between that and our capital, you know, there's been plenty of dry powder to continue doing these acquisitions, and the company is still going back to one of the original goals that Greg and Darren have talked about, the delevering with the acquisitions and the leverage that's been used. I mean, if I have one thing I'd look back and frown a little upon, is we provided the company with some additional capital that was available for acquisitions. And Darren's doing such a good job acquiring them that the bank has been financing him. He hasn't needed some of our, I like to keep calling it value added capital. I think Greg and Darren refer to it as expensive capital sometimes, but it's one and the same. But we certainly would be excited to put more money in as the growth continues. And now that we are looking at some larger acquisitions, there might still be a chance. But you know, certainly excited by that opportunity and continuing the company's path to growth.
No, I appreciate it, Mike. And first, I'll just give kudos to Michael and the team, the Calteus team. I didn't share this earlier, but before I go back in kind of the transaction and how that went, I mean, Michael and Elisa and the whole Calteus team have been really fantastic partners, as Michael alluded to. I'm very protective of who we bring in the portals and the partners of our organization. And I think all of you, Greg knows, and you, Aaron, as well, coming highly referred by Greg. But you know, Michael and I had known each other for 3-4 years, and the high confidence referrals from two people that I know and trust very well were instrumental, I would say, in my confidence in Michael and the team and who they are as people. And that gave me a high level of appreciation for what our partnership would look like. Because you want to know when character is tested, what they're going to look like and how they're going to act and respond. Because my team and my organization is very important that we're in a good place always, and I've got the right people. And so Michael has been a great partner and done everything that they said they're going to do. And I think that we share the right, all the right mindset and approach to the way we treat people and what we expect from the organization. And as part of this, I think going back, Greg knew how important, and you, Aaron, structuring this deal every step of the way. I think it's important. We haven't really shared, but I brought my board in early, who were all really insiders to the organization, to make sure that every step of the way they were participating in this complex transaction, because we had shared so much about the importance of employee ownership, and the ESOP was such a great program, and everybody was completely bought off on that. And so to change that message, it had to be for a really compelling story and a reason, because I wasn't going to be able to go back to our board and to our leadership group next, and then even to the employee organization as a whole, unless the story was very compelling. And at each step of the way, it got more compelling, but then we had to continue to iterate it to make sure that it was really strong and it really captured everything that we needed to do to make sure that this was really elegant and a positive thing for everybody in the organization. And so each step of the way, there were always some missing components that we said, you know what, it's not quite there, it's not quite right. And we needed to continue to work on what was the right solution and how do we make this better. And I mean, again, to Greg's benefit, the whole team at Caltius, and Aaron, to you, very creative. And what do we do to help make this, the whole transaction right, so that our team was excited about it, they were embracing it, and that it worked to accelerate the momentum that we already had. And it was achieved that way. So I go back to first the great work that Greg and the team did with our board, making sure that we were educated, that the board was on the same page. They're like, yeah, this can work. All right, let's do this. And then are we finding the right partners and the right people that get our values and understand and are going to embrace what we're all about and be the right people that understand what our vision is for the future. And then as we got the board on committed to it, which was no small feat, again, just because we had that mindset of we want to be determining our own future and not let somebody else outside that we don't trust have an influence on that. So that was a huge hurdle to be overcome. It was the first time we've actually ever introduced outside capital to a vibrant, growing, healthy organization. And there's always a risk to that, right? So after we got the board on board, I then had to go to my principals, who were meaningful shareholders or influencers of the organization, to know that, hey, here's what's going on. And so that was probably another group of 70 people, I would say, in the organization. And so that presentation, I was like, okay, how's this going to go? And because it was well thought out, we laid out the program of what we're going to do and why we were doing this and what it made, how it was going to impact them, how it was going to impact our team members, and what we were doing to make sure that it was so positive and constructive for everybody. They got it. The thesis made sense, and the program and the structure was so well laid out. It really was. It was a fantastic story. And then after all the principals, it was unanimous. I would not have proceeded forward unless it was unanimous with all of my board members and all of my principals on board. We just take the time to make sure that we're discussing it, we're educating and socializing it before we take the next steps. I don't want to jam anything down anybody's throat. That's just not how I get the momentum of our organization. And so after all the leaders were on board and we were ready to transact this, we did the transaction and shared, because we had the vote of the trustee, our ESOP trustee, on behalf of all of the employee owners, had the unanimous support of our board and our leadership team to say, this makes sense for everybody. This structure works and it's really positive. And so we got the trustee on board with that. And then we shared what we did with the whole team. And I would say there was surprise by it, because we had the ESOP conceptually makes all the sense in the world. But after we explained the reasons that we were doing this, all the team members were on board with it. I would say there was some that were reticent. They're like, okay, we're going to take a little bit of a wait and see, but we had built so much trust over what we had done and the transparency of which we operated our organization that they were like, okay, Darren, I trust in you, I trust in the team and my leaders. All right, let's see this thing through. But I can tell you now, there's nobody 1 year later who doubts anything that we did and the reasons behind it at all. And it's been really, really positive. And I would say we did this to the credit of Greg and the Calteus team and everybody. This whole started right the first 2-3 months after COVID, and basically it was a shutdown, and there was incredible disruption in the world where there was uncertainty. There was a huge question mark of what did the future hold, and I think we had shown and proven that our organization was a high-performing team and really built well with, no concentrations, and that the work that we were doing was going to continue. But it was not easy, and the banks were basically, everybody put their pencils down and said, let's take care of all these PPP loans. I'm not sure that we want to do any new credits. And to our bank's credit, Umpqua, I got to give them a shout out, and also to Michael, is that they were there, had full confidence in us in an uncertain time where the rest of the world was going, I'm not so sure what's ahead. And they were there, totally committed and convinced every step of the way in the face of a very uncertain future for the next couple of years. So they were there. We worked through. We were the first deal out of the bank through the COVID period of time. And it was, I think, a testament to the team that we built and how elegant the structure was, and the partnership that we had in place, that we got this done in a very, very challenging period of time. So big time kudos to everybody from a communication and what we needed to do to make sure that everybody on our team was all on board with it and really embraced this new solution, which has worked very well.
So Darren, a year later, you've described a very disruptive process, not in any way critiquing your partners, because it was a complicated structure, but a year later, how is it proven out? How is the company doing?
Yeah, the company has really accelerated in every way. All of our, I think the testament is that all of those merger partners that had subordinated notes with us at that point in time, 50% of those notes were taken in cash, 50% rolled back into equity of the organization. So to me, that was the first test of, do our leaders believe in what we're doing and the future? And given that they rolled 50% of their money back into shares of the organization, was a great stamp of approval that this was the right thing and that we were doing the right thing and believed in our future. We also then gave people in our organization the opportunity to buy shares directly, in addition to what they rolled through the profit sharing plan. I wanted people to say, hey, you can still invest directly in our organization. I gave this opportunity open to everybody. And I would say we had almost a quarter of the people write checks to the organization just to say, we believe in what we're doing. We believe in our future. And so that was a great validation as well, for people to just stroke a check to help capitalize the organization and provide that future growth capital. And I'd say this, I can't even remember what our growth has been, but I guess I'll represent it this way. We've finished, since in 1 year, we finished 6 or 7 mergers during that period of time. They've all gone very well. Our retention of all of those employee shareholders, all the employee shareholders during the time, is 100%. And they are all accelerating from a growth. They're all really embracing what Salas O'Brien is all about. The employees of those teams, we've given the opportunity to be employee shareholders as well, to write checks. And a significant percent of the population has also written checks to participate in employee ownership. And I think to Michael and the whole team's benefit, is our share price went at the transaction was at $31.65, and we repriced it 4 months later, and it was at $60, and it's going to continue to accelerate in growth from that point in time. Right. So I think everybody's pretty happy in terms of the clients. No impact to the clients at all. We've got tremendously engaged employee owners. The teams are happy because they're able to invest directly. Our cap structure is so much more improved and better than it was previously, and there's really no limit. And they see that all of the teams joining us are able to roll into shares and ownership in the organization. They love the story. They want to participate in the vision of what we've created for the future, and there's betterment for everybody. So it's worked incredibly well. I mean, I couldn't have asked for anything better than the way it's worked.
And Aaron,
Fantastic.
Yeah,
Aaron-
Darren, real quick, I was just going to say maybe because the number, I don't have it right in front of me, of the acquisitions you've done since we closed. And again, you and Greg both pointed out that you having that currency was important. What % of the proceeds you've used for acquisitions have the shareholders of the companies we're acquiring elected? I mean, they could put their foot down and say, we want all cash or something, or, you know, an earn out, but what % of the total acquisition price you've done since closing that have been in shares of Salas O'Brien stock?
I
Ballpark.
don't know, like the exact number. I would say at least 25 to 35%, I would say.
Yeah, that's
I mean,
about what I got.
everybody believes in the shares. They are looking for some liquidity, but they all believe in the future, and some of them want even more. And so we're kind of balancing the dilution of the shares versus the full engagement of from a share exchange, if you want to say.
Got it.
That's been very, very positive.
And Aaron, if I could just add a couple technical points that I probably missed during my overview with respect to the transaction, and these are important, is even though we were 100% S Corp ESOP pre-close, we were still 100% employee-owned post-close. So the ESOP obviously was concentrated in a trust, but here the ownership now is through the profit sharing plan, which you described, right? The direct ownership from the merger partners, those that have written checks, the warrant holders and SAR holders that converted. At the end of the day, this is still 100% employee-owned corporation. Michael's investment is a preferred that converts into common. So on a fully diluted basis, it'd be 80-20, but we can say that 100% of the common stock is owned by Salas O'Brien employees. So that's point number one. Point number two is a technical point, but it's probably worth mentioning because there's probably other advisors and ESOP-owned companies reviewing this, is the ESOP actually didn't sell. We simply just rolled their earned shares into the profit sharing plan. So the trustee did not have a buy-sell decision. It's more of a decision where they treated fairly as a part of the transaction. So it's a technical point, but I think it's probably worth mentioning for some of the folks in the audience.
Those are great. And I appreciate the employee ownership footnote there, Greg, because this is a unique structure. And that's why I wanted to highlight this particular case study for this group. It is one where employee ownership has been retained, and it shows that you can have very powerful employee ownership, not only through an ESOP, but through other structures as well. It just has to be structured right and executed correctly. So with that, I'm going to ask one last question for all three of you gentlemen. Thank you so much for participating. Anything you do differently?
Michael, why don't you start?
Yeah, no, I don't think there's anything that from the getting the deal closed that we would have done differently. I think the structure is correct. As I pointed out, half jokingly, but we'd like to get more money invested in this transaction, and we have allocated it from our fund. And but that is not something I would do differently. It's just as the company continues to grow, we'd like to continue being a growth partner for Darren and the firm. And we've tried to be advice on certain acquisitions and have our team help when they get Darren and his team get a little overwhelmed. We try to be there, and then when their transactions are identified, we try to make it as seamless as possible with our securities and what we need to do to allow the company to keep growing. And hopefully Darren promised we'll get to $90 a share next year, so it's going to be all good. So no, Aaron, I really thought about that because there's always some post things, but at this point, 1 year into it, I don't have anything I look back and kick myself on.
Darren?
I'll chime in first just on Michael. I'd say Michael has been a great counsel and advisor to me. I think good objectivity and helping from an even improved governance perspective. So I try not to give Michael too many public kudos, but I'll have to give him another one that he's been a great partner and done everything that he said he's going to do. And I have a great confidence and trust in him as counsel and an advisor. No, we were blessed, I would say, to have great team and great partners in you and in Greg. And I don't give compliments too easily, only when they're deserved. And it was a very complex transaction. It took a lot of time to get right, and a lot of nuance and a lot of technicality. And it wouldn't have happened with anybody but really a truly high performing expert team. So no regrets at all. Everything went very well. It took a lot of time and a lot of sweat to get to that point in time, and a lot of socialization of the concepts. But at the end of the day, I know there's nothing that I would do differently at all. And I would think there's only one thing that I would share with this, is that we went from a non-tax-paying organization to a tax-paying organization. So my accounting team and our tax work is a lot more complicated than it was. So that is not something that I missed at all. I really enjoyed being an ESOP organization and not have to worry about taxes at all and paying taxes. Now we have a complex tax situation, and fortunately we have the benefit of being kind of in the R&D and the 179D space, which helps us mitigate much of our taxable income on the federal and state side. That was a critical part of our planning process in assessing this right structure. But that's the only thing that I wish that I didn't have to take care of as part of this transaction. But we've been able to mitigate a lot of that through the process. But that's, again, through a lot of planning and consideration of all of these very important components. But no, it was great transaction, great structure, well thought through, and I would 100% do it again.
Greg, any changes?
No, I wouldn't change a thing. Honestly, I'm just very happy and proud to be associated with Darren and Salas O'Brien and Caltius and Michael and you, Aaron. I'm very proud of what we've done, and I'm very proud of the fact that we hit on all of the objectives that Darren set forth with the board, and that we retained 100% employee ownership. So I'm just very proud to be a part of it.
Fantastic. Well, thank you so much, gentlemen. That is it for today, and I greatly appreciate your time.
Thank you for having us.
Thank you.
Take care.
Thank you, Aaron, Greg, Mike.
Thank you, Darren.
Thank you, guys.